Every once in a while, Wall Street makes a massive mistake. They misunderstand a company, price the shares way too low, and if you can find those mistakes, you can make a lot of money. Today, I think I found one. It's a stock that massively benefits from artificial intelligence and data centers, benefits from LNG build out all over North America, and all the investments into natural gas electricity generation all over the world. We're talking about Tourmaline Oil today, Canada's largest natural gas producer. And this is a stock that is so deeply undervalued compared to what its cash flows say, to what the assets are actually going to be worth in the future, and to the value of their infrastructure, that I just cannot ignore the story. I've got for you today some expert analysis, some discounted cash flow models, and I'm going to compare it to some of its peers to show you why I think the short term has been way overblown on this stock, that the stock price has dropped far more than it should have, and why that's such a big opportunity for us as investors in the both short and medium term. And then I'm going to talk to you a little bit about why personally this is the stock I've picked in the space. So we're going to start with some expert analysis here, and this is from IWA Research. These guys did a really good job of breaking down a couple of key facts about the company, but they also do a good job of breaking down some of the key things you got to look for out of the earnings report. Most recent earnings report we've got is from July of 2025. And while there are literally dozens of slides, these guys have picked out a couple of key ones for us to understand the company and why it's so undervalued. Now, if we scroll down here, the first slide they show us obviously is talking introduction and financials. And for those of you that haven't followed our coverage of Tourmaline, a couple of key things here: largest natural gas producer in Canada, but also importantly, they're also the fourth largest Canadian gas processing midstream operator. So they're the fourth largest when it comes to transporting natural gas, which is huge. It creates actually kind of a moat around their business, which in the E&P space is not all that common. Usually your moat is basically just size. If you're bigger, typically you have better synergies. These guys have invested a lot into infrastructure to make themselves a little bit stronger, to build a stronger moat, and to basically mean that they can produce more value with the same assets as others might own, which puts them in a position to acquire a lot of those assets, which we've seen over the last little bit. They also have a huge amount of reserve. They've got low capital costs, and they basically are investment grade, which means it's a lot easier to lend them money, which is good in bad times and great during boom times. Because it means that when things get good and suddenly you want to invest more, you're put in a better position to do that. Also means when things get bad, you can borrow that money and you're not in such a bad spot where you're like struggling to pay it back like we've seen some of their peers. Obviously, we've got some production forecast things, but I think one of the more interesting things that we get from this article is the project summary. So what's actually going on? So obviously in black, you see on the far left side what they're actually producing this year. And then you see all the different things that are going to end up with them producing almost 1 million BOE per day, right? So if you look at that, we're going to get up into the 900 to 950,000, which is the BOE per day, which is just huge. And obviously there's some huge upside there. Like they've got North Montney completion in 26, they got their ground bridge in 27, and you see all of these things. Now, the problem with that over the short term, one of the reasons why the shares have dropped so much, is because investors basically looked at all that investment and said, you're crazy. You're crazy for spending that much money now. You're crazy for trying to, not quite, but essentially double the size of this company, double the production into an environment like this. And if you look at the way 2025 has been, if you look at any natural gas price chart for the year, you'll see it's been brutal. And AECO, the Canadian pricing, has been even worse. Now, Tourmaline has done a really good job of diversifying their markets. So literally selling at different prices in different spaces, basically. But even then, they've suffered a lot from the lower price, right? And you look at some of the value going into there, right? You see some of the things going on. You see some of the money that's being spent, right? So, it's a lot. There's a lot going on there. And well, the fact is that, this year is better than last. They have seen some improvements, at least going into this July earnings report, which if you remember is covering earlier in the year before we saw that summer drop, right? There's still a lot of fear basically on what is happening with the company and how much they're spending, as well as obviously operating costs maybe going up because of all this investment, and seeing where that investment return is going to actually be, because they've already started on this big plan of optimizations and spending money. And yet we've seen very minimal increases in the short term, which is, again, a fear for a lot of investors. But obviously, if you look at what they say they can achieve, because a lot of the shorter term expenses that they've gone through over 24, 25 has been things like that infrastructure, right? The investing into those things, investing into the natural gas processing. And these things don't necessarily generate cash flows in the now. But what they do is they mean that when this company grows from 650,000 to 950,000 or to 1 million or to 1.2 or wherever they end up at in the next decade, that these investments become multipliers on that expansion. And I think that's a big part of what Wall Street missed, because Wall Street instead was talking about all of these investments in the short term as negative, saying like, listen, you guys spent a lot of money, you borrowed a lot of money. Where is the cash flow, right? If you look at some of the things, production per share, look at the 21, 22, 23, 24 chart. If I then told you that I was investing billions of dollars every year and taking out debt, and the operating costs increased every single year, you would probably also be a little bit skeptical if you weren't really paying attention to that long-term chart or to what actually was happening on the ground. And if you think about what amount of research Wall Street is really doing, think about how many analysts cover companies like this. Even as a scale producer of natural gas, we're talking beyond, the Seeking Alpha guys who, like, God bless them, because if they didn't exist, nobody would understand these companies. Beyond that, the actual Wall Street analysts, there are very few covering this space here in Canada, and they're stretched pretty thin because they're expected to cover the whole space for their firms. So I really do think they missed that. And they looked at charts like this and they said, meh, okay. Right? Reserves are going up a little bit. Production per share is going up a little bit. Cash flow per share is actually peaked in 2022 and going down. Operating costs are going up. Short term, bearish. But I think that's a serious mistake. I really, really do think that's a serious mistake. If you look at, I got a couple of numbers that I do want to show you from this chart here. Look at that E&P capital program. So that's what they're spending to achieve the growth that we looked at in that chart earlier, right? And you'll see there's in millions of dollars, we're looking at about $2.5 to $3 billion spend in the next several years, right? You're looking at production. Yeah, it's going to grow massively, but obviously then you put in question, okay, well, what could that money then do in things like, look at that base dividend, right? They're paying out 65 million, and you're spending $3 billion on a capital program, right? So what does that leave for the shareholders, right? And you can see how this story played out. I'm sure a lot of you have played this story in your head. You've seen what I'm talking about here, right? But the long-term story is they're investing a lot of money into the business. And while in the short term, that doesn't turn into a huge amount of growth, you see how in the long term, when that plays out, it does get exponentially better and better and better. And the cash flow that you see, even between 25 and 26 expectations, are big. Cash flow then you see from the 26, 27, again, big cash flow improvements from all these investments into their processing, their midstream, and obviously optimizing the assets they do hold. So just like several things going on there. If you look at a couple of like shorter term guidance things, right, you'll see the sort of the capital expenditure. Again, I'm talking like 3 billion E&P, talking about 2.6 to 2.8 of that, right? And the free cash flow is going to be about 755. And if you then look at some of the things that they're going on in the future, look at the maintenance budget, right? You look at the base dividend, production growth per year at 5%. And then you look at the available funds, which is when you get the special dividend, the base dividend, and all of that. And obviously you see how that relates then to the price of natural gas. And this is where I get so bullish, because if you look at the chart on the left-hand side, which shows you the value per 1,000 cubic feet there, you see cash flow at 1.5 is basically just maintenance. At 2 and a bit there, you see that maintenance and dividend coverage. And they've achieved that because that's a mix of NYMEX and AECO. So that's a mix of US and Canadian pricing. They've achieved that basically every year, right? It's almost never been a problem for them achieving their base dividend. I say almost never. Obviously, there could always be a black swan, but almost never been a problem. And then you go up into where sort of NYMEX is typically trading, right? 4 to a little bit under 4, basically, depending on the season. And sometimes it goes way up. This winter, they're expecting NYMEX to hit 8, which is a huge jump from where they are right now. But you just see, okay, so you get up to that 4, that's where the growth capital comes in. And then you have the free cash flow. And now I want you to think about what this chart would look like if this expanded all the way up to 8. Now, look, what would it look like if it went to 12? What happens if it snows in Texas this year? What happens if you see significant cold snaps? What happens if you see less maintenance being done on LNG facilities next year? LNG Canada is running fully online. You see things like new LNG plants coming online in the States, Mexico getting their LNG plants online, new announcements of natural gas powered data centers all over North America. What happens when that demand becomes constantly well above 4? What happens when that demand pushes things up into the double digits on a consistent basis instead of just that being the price you see on world markets? That's when the story here goes from one of, okay, I see how they could, afford to reinvest this, and they can build their dividend, and they can build, the special dividend, and I can see the short-term value. That's when that translates to long-term value. And that's a really interesting story, especially when we talk about the valuation. Because as we go down, and feel free to check through all this. This is talking about assets, what they owe, what they own. But as you go down and you look at a couple of interesting things, and you look at some of the sensitivities they have in cash flows and things like that, they have a lot of potential. And Wall Street might not like it, because Wall Street doesn't love seeing people investing a lot of money in the short term for longer term gains. Wall Street likes to see people investing money in the short term, making a short term gain, or, for example, investing a bunch of money into AI and then suddenly seeing the valuation of your company massively bloat. Wall Street loves that, because that feeds into their narrative of quarter over quarter, because that's the kind of time frame they live on. But as institutional investors, they can't see what we see. They can't see that, well, okay, this quarter might have sucked, right? When we look at the Q3 report, we're going to be like, oh man, right? Summer is not going to be good. Fall is not going to be great for pricing. But we understand that then is followed by winter. And that's going to be followed by another year with LNG Canada full supply, et cetera, et cetera. Now, I think one of the best things I've seen over the last while to illustrate just how ridiculous Wall Street has gotten on this stock is this chart from Simply Wall Street. And we covered a Simply Wall Street valuation the other day on CNQ, on Canadian Natural Resources, which was, again, insane. Because if you look at what it says right there on the screen, it says that the share price is currently trading about 60 and that fair value is about 158, 160. So there's $100 spread between what the cash flows of this company say it's worth and what the shares are trading at. And I talked to a couple of people in the comments on that CNQ video, and a couple of people both were like, do you trust this valuation? And while the math does work, a lot of people also were like, hey man, listen, the value put on a company is what somebody will pay for it, not what theoretically the cash flow of the company say it's worth. And I think you're right. And I think in this case, that makes my argument even stronger. Because think about what people are willing to pay for a Canadian oil and gas company today. Think about the stigma around that. Whose investable universe is Canadian oil and gas in? If you're watching this video, it's probably yours. It's certainly mine. But think about how many of your neighbors would invest in oil and gas. How many of the big banks really want to put their money in oil and gas? How many American investment firms put their money in big banks and put their money in Canadian oil and gas? Think about where that sort of goes, right? Think about how money flows into these stocks and who actually wants to own them. And I'm sure you can see that that actual market is pretty small in the grand scheme of things, right? It's certainly nowhere near the amount of money that's going into things like tech stocks, not even the amount that's going into Canadian gold stocks. But if you look at those Canadian gold stocks, you'll see what happens when suddenly that narrative shifts. Because this year, and I'll throw up Agnico Eagle, for example, a gold stock that I talk about every once in a while. I love the stock. I own a couple of shares. When the market sentiment shifts and investors are suddenly willing to look at a part of the market they've been ignoring, and suddenly big money starts chasing after those gains, and suddenly institutional investors jump on that, and then American firms go to their banks and say, I want to be in on this. You see how quickly those shares move. Even though in the case of gold, obviously their commodity price ran up, right? They produce at a similar operational efficiency, right? Not a huge amount changed, but their stock prices flew, and they've been flying for a while, and I expect them to continue flying for at least a little while here. So think about what might happen if next year, instead of a depressed, like in Canada, we've had such a brutal price of natural gas, but even in the States, right? A depressed, low, like sub $3 natural gas price that has just basically pushed all investor money away. What if you see an $8 natural gas price? What if you see a crazy high natural gas price through the winter, like a jump, inventories draw right down, And then the shoulder season doesn't see the drop off everyone was waiting for. What about then? What about the opposite of what happened this year? What about if the summer has an incredibly high demand, a high draw? Because all of a sudden, on top of everybody trying to cool their home, now there's all these data centers. Now LNG Canada is online, fully running. Now all these American LNG facilities are fully running. What happens then? Think about how many investors are going to switch their mindsets on this, about how many banks are suddenly going to consider natural gas a much more valuable commodity. When they see that commodity price run up, big money is going to follow. And then the price people are willing to pay for these stocks, they're going to have to get it from somewhere. And why not the cash flows? And if you think about it, these are the estimated cash flows right now. This is based on what analysts are expecting for next year, which, by the way, is not crazy. I'm actually far more bullish than a lot of analysts on the strip price of NYMEX of American natural gas next year. What happens if it goes higher? What happens if the cash flows are dramatically higher? What happens if Tourmaline's smart investments turn into higher and higher free cash flows every single year? Then you're going to see the valuation that these guys are suggesting, which again looks insane right now. $158, wild. You're going to see that as a way in the rearview mirror, as a distant past, because this thing is going to be trading way higher. We're talking double or triple that in a world where you're going to see an incredibly high natural gas price, way more demand, and a lot more institutional money flowing into it. I think that's where the real opportunity is. And I think that story switches soon. I'm filming this middle of October here. If you're watching it the middle of October, then we're waiting on winter coming in the next couple of weeks here. I know I'm in Canada, quite a ways north of a lot of folks, but winter is definitely coming. And when winter starts to come, you'll see inventories draw down. And this winter, we have no idea what the weather's going to be like. But you're going to see that first cold snap. You're going to see the price of natural gas move. You're going to see LNG Canada running at full operations. You're going to see the price of natural gas move. You're going to see the operational work being done on all sorts of parts of the basin here of the Montney in Canada get wrapped up. And all of a sudden, a lot of that gas can be transmitted, right? It can be sent either to the States or to LNG Canada or wherever it needed to go. You're going to see the price of natural gas move. You're going to see operations being done in the States, all this maintenance, all these sort of efficiency things. You're going to see those wrap up. You're going to see the price of natural gas move. You see the story. Everything is lining up at the same time. And what have the stocks done? Nothing. In fact, they're down. Not only are they down, but a lot of investors are nervous about holding them. People are saying they're going to go lower. It's going to get worse because everybody's kind of waiting on the stock market to start showing a little bit more weakness, right? We're looking at maybe recession here in Canada. The US federal government's shut down, right? We don't have the BLS data from the Bureau of Labor, right? We don't know what jobs are looking like. We don't know if there's a recession coming. We don't know what that's going to do to electricity demand. We don't know what that's going to do to natural gas demand. Everybody's nervous because they're all waiting for that short-term downturn. But I think that in the very near future, you're going to see stocks like this start to run. You're going to see investors who are looking to find the next opportunity, somewhere to take their money out of these slightly inflated AI plays, maybe out of their earnings from gold, and they're going to look to deploy them. And maybe that'll take till January. Right? Maybe they're going to wait out the end of the year. They're going to, it'll be more tax efficient for them to not buy until January. But when they do buy, it's going to be a lot and it's going to move the market quick on these stocks. And that's why I think Tourmaline is such an interesting opportunity as well. On the screen here, I've got a mess of charts, a just absolute mess. But I wanted to show you guys how Tourmaline compares to a lot of its peers. So I've got on the list here ARC, who I compare to Tourmaline quite often, right? Maybe a little bit smaller, right? About a $10 billion smaller Canadian natural gas company, but very similar kind of world ARC lives in. We've got Birchcliff, another Canadian sort of oil and gas player. Again, a little bit smaller. We got Peyto, significantly smaller, but again, a natural gas forward, deep basin player. We got Whitecap, another oil and gas name, maybe not quite as natural gas forward, but in the same kind of space. And of course, we got CNQ, who I also think are dramatically undervalued, but much more focused on the oil space, despite obviously being the second largest natural gas producer in the country. And you'll see that Tourmaline is there in the purple. And look at who's at the bottom of the list on a year-to-date chart. They're down 8.7%. They are down the most out of everybody on this list, despite the fact that everybody suffers from the same commodity risk. Everybody suffers from the same short-term risks, the short-term headwinds, the opportunity for market collapse, the opportunity for demand drops, the opportunity for there to be a massively oversupplied oil market. Everybody has the same downside. Yet Tourmaline is the one on the bottom. Because again, the market looked at all that money Tourmaline's been pouring into their capital budget and is saying, what? Why? Why would you be investing in a time like this? You should be panicking, right? That's what these institutional investors want Tourmaline to do. But they're not. They're investing for the longer term. If I even zoom out on this chart, if I show you a 1-year chart, they're still not quite up there. Now they're beating C&Q because the price of oil has been tough over a year, right? But they're being beat by everybody else and by a pretty significant margin, right? They're just below neutral. And I think, again, this goes to show you that when it comes to natural gas, the short-term downsides have been overblown, right? And there's no reason for these guys to be trading this far below Peyto or this far below ARC. There's no reason for that. There's no reason for them to be trading so far below what their cash flows say they're worth. There's no reason for them to be trading down because they invested into long-term cash flow generation at a time when we're looking at long-term opportunities in this market and we're investing tens, if not hundreds of billions of dollars worldwide into natural gas electricity generation. All of this adds up to mean that Tourmaline is undervalued dramatically. And I think that they are one of the best opportunities out there. Now, if you watch the channel consistently, you'll know just the other day I made a very similar video talking about C&Q. And I think these two players have a couple more key things in common that I want to finish on here. Because I think that Tourmaline also has scale. And at a time like this, when you're looking at a commodity stock and you're looking at adding it to a portfolio, I think scale is actually huge because scale gives you a little bit of a cushion. And while it does typically impact valuation, Tourmaline has an added advantage of being so undervalued thanks to their capital allocations, right? Well, normally you would expect somebody like Tourmaline, who's a little bit larger than a Birchcliff, larger than a Peyto, to be trading above them, right? To be doing a little better at hard times. Instead, they're doing a little bit worse thanks to all the investments they've been making. I think that offers even bigger opportunity there. Another thing that they offer, fantastic dividend down to a crazy low price. They made it through one of the most difficult natural gas markets that I have seen, right? We're talking like, this is not quite like 2020 levels, but almost, right? Like it's like seriously bad. Things are seriously bad right now. And the fact that they made it through this market, still paying out their dividend is wild. It's insane. It goes to show you that there's almost no real downside for these companies until you see serious global recession. And while maybe that's on the mind for some investors, I think you're going to see a lot more things break and a lot more companies drop way worse than guys like this. And no matter what happens in the long run, these guys are going to generate a huge amount of cash. They're going to generate great shareholder returns. We're talking crazy. Like they have the potential for insane share buybacks if something doesn't switch fast, right? If you see the price of natural gas start to run up, right? Obviously they'll pay you the special dividend, but like think about the amount of the company they could be buying back and the way that would like just dramatically increase the value per share, the earnings per share, right? All these metrics that the Wall Street guys that are so short-term focus on, right? All of a sudden those guys would be just chomping at the bit to own the stocks, right? Think about the amount of dividend they could offer theoretically. If you do see again, I'm not exactly shooting for the moon, but I'm being pretty optimistic here, an $8 to $12 NYMEX, right? If you see a big bump as inventories draw down and everybody who has been cutting wells down in the Permian suddenly realizes that natural gas is in demand and Tourmaline has to send it down there, right? Think about the amount of value they could generate, the amount of dividend they could pay out. It will absolutely move markets. And that's winter, man. Like I'm not talking a year, 2 years, 3 years. I'm talking like a couple of months until you start to see some seriously bullish signs. And as an investor, when everybody's out on something like this, and yet there are all these potential bull signals shooting in the future, I just get so excited. So that's why I'm buying Tourmaline. That's why it's become my biggest natural gas position. It's not quite the same size as C&Q in the long run, but still very, very bullish on the company. Big fan of what they're doing. And I think the undervaluation opportunity here is huge. I would love to hear your thoughts in the comments down below. Let me know a couple other names that you think are interesting. I've got a couple in the pipeline from stocks and comments that I've seen people sort of talking about over the last little bit, but I'd love to see a couple more. And Do you own the shares? Do you agree with me? Do you think I'm maybe over exaggerating the undervaluation opportunity here? Do you think there's other different sectors maybe that are even more undervalued? Love to hear your thoughts about that in the comments. If you made it this far in the video and you like what we do here on the channel, please do like the video. If you like covering these Canadian topics and going into these things that very few people talk about here, please do subscribe. And I hope I see you in the next one.